Inflation plays an important role in the stock market this year. The annual inflation rate in the US slowed for a fourth month to 7.7% in October, the lowest since January, and below forecasts of 8%. The Fed has made it very clear that its policy objective is to return inflation to its target rate of 2%. However, the inflation rate for this year has stayed above 6%. Recently, I listened to an episode of the What Goes Up podcast by Bloomberg. They invited Vincent Deluard, the director of global macro strategy at brokerage StoneX Financial, to explain why he believes inflation will remain stubbornly high. His viewpoints on macroeconomics are remarkable, and I would like to share some of the highlights from the podcast in this video. Basically, Vincent believes that inflation will remain as high as 5% over the next decade. He believes that the true pivot of 2023 will not be the 2 or 3 rate cuts that the market currently has priced. He thinks the terminal rate will reach 5%. The terminal rate is the level at which the Fed is expected to stop raising interest rates. But then rates do not drop after mid-2023 like the futures market expects, because inflation doesn't really drop. The reason inflation doesn't drop is because by then inflation will be mostly about wages, and wages, Vincent expects, will be around 4% to 5% by then. So, what he tried to say is the inflation of next year does not really drop is because of the labor market will still remain strong. Vincent believes that inflation will drop to 4 to 5% in the first half of the year. By that time, the Fed funds rate will have risen to 4% to 5%. He thinks the Fed will consider this as mission accomplished, as the Fed funds rate will be higher than inflation. After that, the host asked whether the Fed will get rid of its 2% target or not. Vincent thinks the Fed will, and he also mentioned that this wouldn't be the worst thing in the world. The 2% target rate is a made-up number, he says. It came from a press conference in New Zealand in the late 80s. There's no scientific backing behind the 2%. He also mentioned that economic growth will become faster when inflation has been in the 4% to 5% range. After that, Vincent listed out 3 factors that prove that the 2% inflation target is gone. These 3 factors are cheap labor, cheap goods, and cheap capital. If we look at the demographics of China, we'll see a massive crunch in the population of young workers in China because of the one-child policy. This means we don't have cheap goods from China, we don't have cheap labor from Mexico, and we don't have cheap capital from other countries. As the US had massive deficits in the late 90s, this meant that all these countries like Europe, Germany, Japan that had very large surpluses, as well as commodity-producing countries like Saudi Arabia, had surpluses that flowed back into the US Treasury market. However, Vincent said there is still a chance that inflation will drop to 2% if Powell wants to be like Volcker and he gets the Fed funds rate up to 10%. But he doesn't think this is a good idea because it will definitely destroy the labor market. Personally, I think investors need to understand Vincent's viewpoints because they are quite important. If the next 10 years remain in high inflation, then we should not invest like we did in the last decade. For instance, the Dow Jones Industrial Average, which was just above 800 at the start of the 1970s, had only advanced to about 839 by the end of the decade, an overall gain of 5% over this 10-year period. This is totally different compared to the last decade, which started above 10,000 and doubled over the decade. If you have other opinions, let's comment below. Please help to like and subscribe.